If you had bought $10,000 worth of Microsoft shares exactly 20 years ago, that investment would now be worth $140,000. A $10,000 investment in Google would now be worth $250,000, and if you had invested in Amazon, the $10,000 investment would now be worth $1 million today. These software stocks, along with many other companies just like them, have experienced exponential growth over the last 20 years, providing incredible returns to early investors. But the next 20 years are not going to look like the last 20 years. The winning stocks of tomorrow won't be the same as the ones from yesterday. A new market dominance is coming, and the stock market panic that we are seeing today is providing a unique opportunity to catch it. Our job at Bravos Research is to find the best assets, sectors, and stocks regardless of market conditions. We're currently up over 50% on 3 of our trades on gold. We're up over 30% on our trade on BYD. We're up over 50% on a stock called UAMY that is benefiting massively from the trade war with China. And in this video, I'm going to show you the next big trade that we're eyeing. By the way, this is your last chance to take advantage of the 30% discount that we're doing on our service at Bravos Research to celebrate hitting the 500,000 subscriber mark. So if you want to have access to all of our trades, make sure not to miss it. In 2002, the software industry made up about 5% of the S&P 500 index, with companies like Microsoft, Oracle, and Adobe. As the sector experienced extreme growth over the course of the last 20 years, we now have software companies making up about 27% of the S&P 500, with giants like Microsoft, Alphabet, Amazon, Meta, Netflix, but also Adobe, Salesforce, Oracle, and ServiceNow. Software has gained an absolutely massive share of the US stock market, but as I'm going to show you in this video, we may have seen it reach its peak, and other better positioned industries could begin to displace the software industry. But before we look at that, we first need to understand why software came to dominate in the first place. The internet boom triggered extremely high demand for software. Businesses needed websites, emails, e-commerce capabilities, digital accounting, data crunching, all things that require software. But despite this high demand, the supply of software was very limited. Software was a rare, precious resource. The reason for this is because the barrier to entry was extremely high, meaning it was difficult and expensive to launch a software company. Few people actually knew how to code software in the early 2000s, and back then you didn't have cloud computing, so software businesses actually needed to buy physical servers, which was expensive. The launch of a single software product in the early 2000s could cost hundreds of thousands of dollars, and this high barrier to entry meant that existing companies faced very little competition. So this was an industry with an extremely rapid rate of growth and very low competition. But today the situation has changed. The software industry is still experiencing growth, but it's much less rapid than in the early 2000s. Back then, the entire world needed to be digitized. Today, most companies have already adopted all the necessary digital tools that they need. And in terms of competition in the software industry, it has become incredibly high. The number of software developers has quadrupled over the last 20 years, and they have much more efficient tools to code with. There even exists no-code platform, which lets users build applications and software without even needing to know the basics of coding. And the cherry on top is, of course, artificial intelligence that is revolutionizing the software industry by generating code all on its own, so lowering the barrier to entry for software companies to practically zero. This is why, although between 2002 and 2020, the software sector outperformed the S&P 500 by 239%, gaining a significantly larger share of the US stock market in the process. But since 2021, believe it or not, we've actually seen software companies underperform the S&P 500. Since their peak of outperformance in 2021, the software sector has underperformed the rest of the stock market by 15%. So that's 4 years of underperformance. Now, don't get me wrong, the software industry will keep on growing, but it is unlikely to experience as much growth as it has over the last 20 years. So now you might be wondering, what is going to take software's place? What industry will be outperforming all the others over the next 10 years? Well, to answer that question, we need to identify an industry that has an extremely rapid rate of growth and also has a very high barrier to entry, limiting competition, just like software did in the early 2000s. We think the semiconductor industry fits that bill today and could see massive growth over the coming years. Demand for semiconductors has been growing exponentially over the last 2 years and is very likely to keep on growing at a very rapid pace. Similar to how businesses needed to adopt software in the early 2000s, today companies need to adopt AI. And the biggest bottleneck for AI adoption today is the semiconductor industry that has an extremely high barrier to entry. For starters, there's a limited talent pool with very few true experts in nanochip manufacturing required to build AI semiconductors. This also happens to be an extremely capital-intensive business. It costs about $10 to $20 billion to build a semiconductor lab, so that makes competition in the semiconductor space virtually non-existent. With low competition, companies can easily increase their pricing and so increase their profit margins. And that's exactly what we've seen happen with the semiconductor sector over the last couple of years. It's gone from 25% in early 2023 to now almost 40%. So this combination of high growth and low competition puts the semiconductor industry in a similar position to where software was in the early 2000s. Now, I know what some of you are going to say, but Peter, semiconductor stocks have already posted ridiculous returns over the last few years. There's no way that can last. And indeed, the semiconductor industry has gone from representing about 6% of the S&P 500's total market cap in 2022 to now standing at about 12%. So it has already gained a significant share of the market. But if we compare that to the 27% market share of the software industry, you can imagine a world where semiconductor stocks gain much more ground than they already have. In the early 1900s, the industrial giants of US Steel, Standard Oil, Ford, and General Motors together made up approximately 40% of the total US stock market capitalization. Is it possible that artificial intelligence ends up creating this kind of extreme dominance of semiconductor companies in the S&P 500? We're certainly not ruling that out. This is why we are closely watching the semiconductor sector for potential trades at Bravos Research. We haven't initiated any just yet because market volatility is too high and these stocks are currently trending lower, but as soon as the market shows signs of starting a sustainable rally, we'll be looking to initiate trades on semiconductor stocks again, as the next leg up could be just as aggressive as the one that occurred throughout 2023 and 2024. We'll be picking the best names in the sector that we think will be outperformers in the next bull market in semiconductor stocks. Again, if you want to have access to all of our trades, make sure not to miss the 30% discount that we're doing on our service. I look forward to seeing you there.